Welcome to Turning Hard Times into Good Times. I'm Jay Taylor, and I'm talking to you from New York City on this, the 9th day of November 2021. I should mention to you that while the vast majority of you who listen to this show do so by way of podcast, it is also possible to listen to the show live on your computer or smartphone. To do that, you can go to voiceamerica.com /show /1501. That's voiceamerica.com /show /1501. Before I talk more about today's show or introduce today's show, let me just remind you once again, I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can go to miningstocks.com to sign up for that. Chen Lin, you can subscribe to Chen's Lin. What is Chen buying? What is Chen selling? Go to chenpicks.com. And you can subscribe, if you're smart, you will subscribe to Michael Oliver's Momentum and Structural Analysis. You go to olivermsa.com, olivermsa.com, and we'll be talking to Michael Oliver in just a few minutes from now. I do want to thank all of you for listening to the show and encourage you to continue sending on your questions or comments, whatever you have, ideas about the show, send them to questions for taylor@gmail.com. And we do need to thank our sponsors, because without them there would be no show. Novo Resources, El Oro Resources, Hannon Metals, Labrador Gold Corp, Lion One Metals, SK Mining Corp, and Firefox Gold. Those are the sponsors for today's show. Before I introduce today's show, I want to remind listeners that I will be participating in the Metals Investor Forum this coming Friday and Saturday in Vancouver at the JW Marriott Park Hotel. And to either attend this in person or virtually, you need to go to metalsinvestorforum.com, metalsinvestorforum.com. Simply enter your name and email address, and you'll have entry either virtually or in person at the Marriott in Vancouver to attend this event. That goes for 2 days. That's Friday and Saturday. I will be speaking on Friday. The title of my talk is Why Inflation is Not Transitory and the Great Crossover is Underway. The show title today, it's Time for Gold Miners and Other Value Stocks. Lynn Alden, Dr. Quentin Henning, and as I said, Michael Oliver is with me today. Gold and silver miners are the only non-financial sector in the S&P 500 that has been generating real positive free cash flows after you consider inflation, real positive cash flows, and the only segment, a non-financial segment in the S&P 500 that has been doing so. Yet the value-orientated gold shares are not performing anything like growth stocks and a lot of other, well, the growth stock sector anyway. And Lynn Alden will be with me to talk about that. She believes the tables may be about to turn in that regard. Interestingly enough, something like 82% over the last 92 years, 82% of the time, value stocks have outperformed growth stocks. But we have these weird periods of time, like the one we're in now, in which craziness just goes, well, people just go crazy with ideas and growth. And sometimes, I guess, when the interest rates are really low, that has something to do with it. We'll be getting more of the insights from Lynn when she comes on in the second half of today's show. The major gold and silver miners that are producing profits are, however, running out of ore. So they're going to have to find some big deposits, and one possible big deposit or may come from SK Mining. And Dr. Quentin Henning will be with us in the second segment to talk about Consolidated SK project that is SK Mining's project, and a really exciting story. They just came out with some great drill results on Monday, so we'll get Quentin's take on that when he's with us right after our first commercial break. But right now I'm happy to tell you that Michael Oliver is here again. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
It's good to be back, and it's good to have you with us on a day when things are starting to look up, perhaps, for gold. You sent me a note this morning, and you said that gold is at the gates. Tell us what you mean by that.
Well, the momentum gates, anyway. And even if you look at a price chart and just go back to July, for example, there was a rally that peaked in the 1830s, fell back down. And then in September, 1830s, fell back down. We're in the 1830s again. Mm-hmm. So that's a fairly minor shelf for the price guys. The big shelf that most price chart watchers are looking at is just above 1900. That's where you peaked back in January, a secondary peak, that is. The main peak was in August last year, of course. But the secondary high was just above 1900 in January and again in May. So I think that's the level where the price guys are going to say, "Ooh, wake up." you clear 1900 by much. But from a momentum standpoint, when we measure price in its relationship to its three-quarter moving average, there's a massive structure, similar to those price chart structures, a flat line, in other words, that we're now oozing out above here. And the key number for us is to close out any week during this quarter at 1825 or higher. Well, right now we're in the 1830s, but it's not Friday. But that would look real good to us. Now, silver's got a comparable level. And frankly, it's about $1 above the market in the silver market, where it unleashes. But it looks to us like this up-down congestion zone that we've had in gold and downside in the miners and silver since last summer is ending. And I think if it's going to end with abruptness and market violence, meaning if you unleash gold here, I think when you uncork it, it's going to move. It's not going to inch its way higher. I don't think you have to work your way back through the old highs once you clear this hurdle we're at right now on momentum. So we're very excited about what we're seeing, and in other markets out the side mirrors that we want to see doing similar or opposite things, they're tending to do that, especially the T-bond market. T-bonds, as we all know, at least for the last year or so, has been moving fairly coincident with gold. I'm not talking the short-term debt markets, but the long-term 30-year T-bonds. And, they peaked, price-wise in the last week of July of 2020. When did gold make its peak weekly close? The very next week. First week of August 2020. Yeah. When did bonds make their corrective low? March of 2021. When did gold make its corrective low that has not come out since? March of 21. So they're inhaling and exhaling fairly in sympathy. I think it means that asset managers of size who have skepticism about the stock market as a risk-reward situation are moving their money into safer places.
Well, it certainly would seem so, but safer places into the long bond when you're negative real yields, that doesn't seem all that safe, but I guess you got to go somewhere.
It's a parking place for a while anyway.
Yeah.
It's like, instead of your bank account, Okay.
It may be a parking place for a while, but I have to think, and I'm just looking at the gold chart right now in Kitco, and since we started talking, it's gone up a couple more dollars to 1832 on the bid. Looks very strong today, and so I have to think that it's that beach ball suppressed under the water that you talk about potentially.
Yeah.
And the Lord knows we've seen the beach ball shoved under the water very harshly by I'd say the bullion banks, but whatever, eventually Mother Nature prevails. So what about silver and gold stocks then? Which do you like more right now?
Well, I prefer silver over gold, and this is a technical observation, by the way, not just a gut preference. And when I look at the miners, in fact, we put out a report today on relative performance showing how does GDX, for example, the gold mining ETF, do versus gold for the last 5-6 years in terms of relative performance. GDXJ, the juniors. And then we look at the silver, SIL, which is silver miner ETF, and also the junior silver miner ETF, SILJ. And when I look at all four of them, I expect all of them to beat gold on the upside. They tend to do worse than gold on the downside. Meaning when gold pulls back, they pull back more, but when gold goes up, they go up more. So if we're breaking out in gold on a net basis here, our quarterly momentum I was talking about, then I would turn to the miners. But when I turn to the miners, it looks to us like the silver miners are better placed than the gold miners on a relative performance basis. So that's where I would turn my focus right now. So if gold breaks out over our numbers, I think the place to go is use gold as the mama market, but go into the silver miners is our preference in terms of likely to beat the others. It's possibly because they were largely more depressed than the others as well.
Sure.
So the beach ball has been submerged deeper, and so when you let go of it, it comes whooshing up. But that's where I'd look, at silver miners.
All right, Michael, last week Gwen Preston was a guest on our show, and she was ringing the bell for uranium. What are your thoughts on that? I know you follow that market.
We look at it every few months. We got bullish a couple of years ago, in fact. and it's done what we expected it to do, and it's no doubt got more to do. I don't have a current assessment on it. We had expected this surge several months ago to take out a prominent high that was made several years ago. I think it was at $44, and it's done that. So, it's taking a breather, I think, right now. But it, like the other energy stocks, has been depressed for a long time, energy futures markets. And I think that there's more to go in the energy sector. Our favorite, though, is natural gas in terms of likely percentage gain. So we favor natural gas over crude. And uranium, unfortunately, you have to go to stocks only. The futures market is extremely illiquid, almost non-existent, just enough to get a daily price, maybe. But uranium looks solid, and I think the world is going to start to turn. The French are already in that direction. There was 70% plus of their energy comes from nuclear. So
well, if you want to avoid freezing to death, and if you want to go green and avoid freezing to death, that's about the only alternative. I think. I don't know when people are going to wake up to that fact, but it seems to be the case.
It's definitely a safe alternative. I mean, you can count the number of people that died in uranium accidents around the world, like the Russian thing near Chernobyl, in hundreds. But count the number of coal miners that have died and so forth and so on. So it's really a fairly safe energy source. I don't know why people dislike it, but anyway.
Yeah. Well, I guess it's the cataclysmic event that occurs once in a while. But anyway, that's another subject for another day. So you really like the oil and gas sector and natural gas. I think there's an ETF or so you can play in natural gas as well. So, and I guess you still like the grains and fertilizers.
Yeah, so the fertilizer stocks, particularly, they've done quite well. In fact, the ones we picked have already tripled over the last year. CF Industries and Mosaic. So we think there's a lot more there. And natural gas will have an impact on that because natural gas is used in the manufacture of fertilizer, key ingredient in the process of making it. And so if you have a natural gas tightening of supply or a rising in price, it cuts into the profitability of the companies that make fertilizer. Hence, you could dent the supply. Well, if you dent supply of fertilizer, what's it going to do to the crop yields next year?
Right, exactly.
So it's one domino topples into another,
Well, and of course, folks, you can go to olivermsa.com and sign up. And you'll get not just every other week to hear Mike on this show, but you can keep up with his constant flow of information, charts, momentum, structural analysis that he puts out. Very, very important. Something I don't want to be without. So thank you again, Michael, for being with us. Always a pleasure having you.